Hello, everyone. I'm Kristen Hallam from the SABEW Training Committee, and I'm a content strategist at S&P Global Market Intelligence. On behalf of SABEW, welcome to today's webinar on reporting during economic uncertainty. We have a great moderator and panel for you today. Our moderator is Scott Lanman, Managing Editor of Economy Coverage at Bloomberg in Washington. And joining us are our panelists, Chris Rugaber, an economics reporter at the Associated Press, Gwynn Guilford, an economics reporter at the Wall Street Journal, and Eshe Nelson, business and economics reporter for the New York Times. Welcome to our panel. And to our listeners, if you have a question for the panel, please drop it in the Zoom chat. Also, feel free to use the hashtag SABEW on Twitter if you are live tweeting from this event. With that, I will hand things over to Scott.
Thanks so much, Kristen. It's great to be with everybody today. Thanks to everybody who's joining us on the Zoom. I really like that introduction, how you were reading everybody's name, then one by one, we kind of turned on our cameras, so it looked like we were all sort of introducing ourselves, almost Hollywood style there. Anyway, it's a pretty crazy time for the U.S. economy right now. It's been pretty crazy for the last year. You have consumer prices rising at the fastest pace in 4 decades. You have the Federal Reserve raising interest rates essentially at the fastest pace in 4 decades. You know, a couple of us, 3 of us, I think here spend most of our time covering the U.S. economy, but the global economy has just really gotten back in the headlines over the past week as the UK unveiled a fiscal plan and tax cut package that's really sent shudders through financial markets in the UK and also kind of raised eyebrows around the world. So we're going to discuss all those issues and hopefully provide some useful tips and you know, help digest what we cover on a day-to-day basis for a broader audience. I did want to start out. I'll go to Chris first. Chris, why don't you talk a little bit about what the Federal Reserve has done lately, what the impact has been, you know, how to put this in the historic context, since it seems like every time we write something, it's, you know, the first time the Fed has done this in X number of years. You know, a lot of historicals lately. Why don't you go ahead?
Sure, thank you. Yeah, this is a big story, as Scott said. It's a great one to be on right now. I mean, other than the fact that it often is bad news. But the Fed has been raising rates at the fastest pace in about 4 decades. Like Scott said, you know, all these things are the fastest since then and fastest since different times. And so by doing that, they, as many of you know, of course, have raised the cost of borrowing all sort of across the economy. We've seen mortgage rates more than double. And it has just been very rapid. I mean, at the beginning of the year and as late as early March, the Fed's target interest rate was 0% or between 0 and a quarter point. Now it's between 3 and 3/4 of a point, 3 and 1/4 of a point. So that's a very historic quick increase, and it'll take time to play out. For real estate, I think we're going to see, for example, something that comes up when the Fed raises rates. You'll look at how this affects the housing market. You'll probably see what's sometimes called rate lock, where, you know, people have, and, you know, there are going to be millions or tens of millions of people with a mortgage rate in the 3% range or even below. And so when they, you know, are they going to move? Are they going to buy a new home where they would have to double that mortgage rate? That'll be interesting to see how that plays out. I mean, this is just an example of, you know, the Fed is often seen as a remote or sort of, you know, a remote institution. I'm going to date myself a little bit, but I can remember Tina Fey on Saturday Night Live making a joke when she read off that, you know, she read the line that the Fed has raised interest rates today, and she said, "I have read that many times and I don't know what it means." But actually it's not, you know, as many of you I'm sure know, it's not really that complicated. It does create these real world impacts that I think all of us, and you know, all of us are trying to cover, and by looking at the real world impacts, obviously brings it home to people. So again, I think, so real estate is a big area. If people are going to have to double their mortgage rate to buy a new home, we'll see how that affects remote work. If someone has gotten a new job offer, are they really going to move to another city and again pay a higher mortgage rate, or will they try to hold on to their home and continue to do remote work? But even more so, the Fed is trying to bring down this very high inflation rate, and they are coming as close as I think they can to saying, and in some cases they've said outright that they will take a recession or accept a recession if that is what is necessary. So we are in this interesting period of just sort of waiting for these shoes to drop. The last two recessions, if you go back to the financial crisis, was relatively quick. Obviously, the pandemic was very rapid recession, and now we're in this situation where almost every economic indicator that comes out, the monthly jobs reports, even the weekly jobless claims, which came out today, all of those are taking on greater weight as we sort of watch and see how these Fed rate hikes are impacting things. And the Fed is hoping, as many of you know, to try to bring down things like job openings, which are in a monthly report known as the JOLTS report. They are hoping that by bringing down job openings, they reduce demand for labor and reduce the need of companies to offer higher pay. And that might slow wage growth. And the hope is that they will do that, by slowing wage growth, they reduce inflation pressures, and they can do all that without causing so many layoffs, and maybe not cause a recession, although that is getting, sort of a narrower and narrower path. So this is one of our challenges, explaining to people why is it that this institution is trying to slow, our raises, slow our wage gains. But this is, they of course are afraid of a 1970s style runaway inflation kind of situation. So, and then of course the argument is that in the long term, at least from the Fed's view, it's better to take some pain now potentially rather than later. So there are all kinds of repercussions. There is also obviously an international impact, as Scott mentioned. When the Fed raises rates, we've already seen the dollar go up a lot, and that has all kinds of impacts as well. So there's a lot of things to mine here, no question.
Thanks, Chris. Gwynn, why don't you talk a little bit more about what's actually been happening with consumer prices and inflation over the past year, and also more detail on the labor markets, and as Chris brought up, JOLTS, we have that coming up next week, as well as the next jobs report. So what's been happening there, and how do you explain some of the phenomena?
Sure. So I'll start with, there's been this, we're at a turning point, right? And these things are changing incredibly fast. Like in January, we have this survey of economists every quarter, and about 18% of our respondents expected a recession in the next 12 months. Okay, come summer, that's 50%. And now, just on the straw poll of my regular reporting, that's a lot higher. So what's changed, right? Inflation is proven to be, it's high, but it's not just high, it's persistently high. It's broadening, meaning more things, more products, more goods and services are rising more. And that's a problem because, well, the stickier these inflation pressures are, the more the Fed has to react, as Chris has gotten into. So why is inflation high, right? And what does that mean for the outlook? So at the beginning of, this kind of like crazy inflation flare up, year and a half ago, a lot of those price pressures were supply driven. The cars was a case in point. You had the semiconductor production problems and, a shortage of all those, and, car prices have gone through the roof, right? Used and new. Microcosm of what we saw throughout the economy. But as we moved into this year, and then energy also too, with, the Russia-Ukraine situation, exacerbating that a lot. But as we moved into this year, it's increasingly, the supply things are actually getting better, but demand has really moved to the fore. And that's pressure that's coming from the labor market. we just don't have enough workers to fill all the jobs we need. And that's putting upward pressure on wages. And then also we're adding jobs at an incredible pace. Like in the last 6 months, we've added as many jobs as in more, I think, than all of 2019. It's just really, really remarkable, especially given that there aren't that many workers left to hire, right? So, usually when you talk to economists about, or, a few months ago, you'd be like, yeah, what's going to happen with inflation? Well, and the common kind of cant is inflation is its own cure, meaning that as inflation starts to eat into your purchasing power, you pull back on spending. That's happened a little. We saw it with gasoline, but it hasn't happened in a broad enough based way to make a dent in inflation pressures. And, when you add huge job gains plus the fastest wage growth in several decades, it's just pumping more money into the economy, regardless of what the individual is experiencing. So, there are some economists who think we're in a recession right now. And you can look at consumer spending and retail sales, business investment, obviously the housing market, those things are cooling or in the latter case slumping. And obviously we had negative GDP growth in Q1 and Q2. I think Chris could address the technicalities there. But that cooling, it's happening, but it is not denting the labor market in a meaningful enough way to take those pressures away. And, so that's where we're left with this uncertainty of why is the labor market behaving this way? And, many economists think that many of the supply chain things and, gradual cooling of demand is enough to bring down inflation in a way that hopefully, so that August's horrifying print, won't be repeated. But many also think that it's going to take some, significant job losses to break inflation. And, that's where we are.
Thanks very much, Gwynn. As interesting as has been with the Fed and the US economy, what's happening in the UK over the past week is probably going to be talked about for years or decades to come. And Eshe's been right in the middle of it. I think she's had a pretty busy past week or so. Eshe, can you talk about what's happening in the UK with the government's proposal, the sudden drop in the pound, the Bank of England stepping in, and how that all factors into the global economy and potentially the US as well?
Of course, this was already a really interesting year in the UK and Europe for the economy. But yeah, this past week has been honestly like nothing else. So just to, I guess, give a little bit of context here, we had a new government come in not that long ago, less than a month ago, about 3 weeks ago, and they are a subset of the Conservative Party that have kind of become like Brexit true believers, who have an ideology that we know about through a book they wrote about a decade ago, really kind of extolling the virtues of free markets, tax cuts, deregulation, things you would know from your history books and from Reagan. But they went into office, and the first thing they did was announce a huge plan to cap household energy bills for 2 winters. So not even just this current winter, but the one afterwards. And the very same day, Queen Elizabeth II died. So they announced this huge policy. They did not say how much it would cost, but the estimates are 150 billion pounds. But there was almost no opportunity to really take a look at it because everything shifted and the country went into this 10-day period of mourning. And while that was happening, markets are still going on behind the scenes. The economic situation in the UK isn't actually changing that much. And we will get it. And we got another inflation print showing that inflation in the UK was 9.9%. This is a 40-year high, really scary numbers. And then as soon as this national mourning period ended, they kind of tried to come back out in force. They had a plan to cap energy costs for businesses as well. The Bank of England said, we're raising rates, but not too much. We need to wait and see into what happens tomorrow. And that brings us to last Friday, when Kwasi Kwarteng, the new Chancellor of the Exchequer, got up in Parliament and announced the government's kind of big economic policy. And actually, a lot of the policies we knew about in advance. They warned us they were going to cut taxes, and that's what they did. They told us they wanted to do deregulation, and that's what they did. But they threw in a few surprises there. They cut our very highest income tax rate. They just abolished it entirely. They cut another income tax. And they did something that really upset economists and markets, which was they didn't have an independent government watchdog. It's called the Office for Budget Responsibility, kind of score their measures. So they announced about 45 billion in tax cuts, and this is using kind of old numbers and forecasts. So we'll just say that for now. And they did not say what that impact was going to be on the economy, on the debt. They just kind of put it out there. And with inflation so high, people did not agree that these were supply side reforms. They thought this is just going to stoke inflation. It's going to make the Bank of England come in even more heavy-handed. We're going to have something like what you're seeing in the US, where the Fed is saying, well, we're just going to raise interest rates. And if a recession is what we get, then a recession is what we get. And it just really spooked people. And it shows how much kind of fiscal credibility matters, because you know, not just what are your policies, but how are you delivering them, and how are you promising people that you're going to stick to some sort of rules and guidelines that you set out. And so reaction was really stark in markets. You know, pound fell to a record low. We now have people suggesting that we could get to parity with the dollar this year, which a couple of months ago would have been unheard of. Like, it's inconceivable to me that this is something we're so close to being at. Bonds dropped, their yields went sky high, and we actually had the Bank of England intervene yesterday and say it's going to start buying long-dated government bonds because it got really worried about some dysfunction that was happening in the long end of the market to do with pension funds. You know, I'm not going to get into the detail here, but it was bad enough that they had to intervene and start buying bonds when just the day before the chief economist has said we are sticking to our plan to sell bonds back to the market. It was like a whole U-turn brought about by this market dysfunction. So yeah, things have really gotten very interesting here. And the question is, what happens now? The government has said it's committed to its plan. We heard from the Prime Minister today. She said she's committed. She said she's willing to take controversial decisions. And we're told we'll get more information in about 2 months' time. But I don't think anyone is going to be willing to wait 2 months to hear what the OBR make of these policies.
Thank you, Eshe. That was a great summing up of everything that's happened over the past week. It feels like a whole kind of year or months of news has been crammed into just the last few days. It is interesting, since we are talking about fiscal policy. One thing we did want to discuss is there is a fiscal policy angle in the U.S. as well. The Congress passed, President Biden signed the Inflation Reduction Act. Not too long ago, and that's in the process of being implemented. Either Chris or Gwynn, do you want to jump in and say, what that law does, and will it really reduce inflation? How are you covering it?
I mean, I can jump in. Well, yeah, the law was, it was something that started. I mean, I think the roots of it were the Build Back Better, and which was a huge spending plan, actually. And then there was they did add some provisions to offset the cost of the remaining spending. So a lot of it is on climate change and some healthcare expansion. But they did offset those costs with things like tax on share buybacks. And so by reducing, I think it's an estimated $250 billion reduction in the federal government's deficit over a decade. And since all things equal, a lower deficit generally can help reduce inflation, they decided to call it the Inflation Reduction Act. It's probably not, I mean, most independent analyses say it will probably not have any impact at all. I mean, it's just too small. And then, of course, by using that rhetoric, the Biden administration opened itself up to, well, what's the impact of things like the student forgiveness, debt forgiveness plan that they've announced? So, which, I mean, it gets complicated. Some argue that obviously puts more money or frees up more money for people to spend, which could worsen inflation. So, but it's interesting. I think, the other aspect of this really is that both parties are happy to let the Fed do their thing, and which is, historically the Fed has often come under political attack when they are raising rates and slowing the economy. It will be interesting to see how long that lasts. I mean, I think that's the thing, and I think that's probably true in other countries around the world as well, that as central banks hike their interest rates, presumably at some point the unemployment rate will climb, inflation will almost certainly come down to either just because gas prices and other things clear up, or the Fed's policies will start to bite. And then you will have a much tougher trade-off, and then that could be politically fraught. But it's interesting, and I do think both what the Biden administration has done and sort of in a barely related way in the UK, I mean, you're seeing that inflation is not just something the Fed deals with. I mean, and we haven't sort of seen this. I mean, there was sort of a free money era during the pandemic, and now we're seeing that governments can't spend as much as they maybe want, or cut taxes or whatever, without having this impact. So it's another new angle, I think, that has come around with inflation being so high.
Thanks. One thing we're just hearing a bit about the pound plunging in recent days, and I think Chris might have mentioned earlier that the Fed's interest rate increases were having the effect of sending the dollar higher. And in fact, that's also been a big economic story this year. The dollar is just reaching fresh highs almost every day against many other currencies around the world. We are starting to hear more and more about our other countries, how it's hurting other countries. I know the New York Times just put that story on their front page yesterday or the day before. Eshe, maybe you or Gwynn want to talk a bit more about, what the impact of a rising dollar is on the U.S. economy, and also why we should care about its impact around the world.
Well, maybe Gwynn, you should start by talking about the impact in the US, and I'll gather some thoughts on what it means for the rest of us.
Sure. Yeah, I won't give you much of a breather, though. In theory, the strong dollar takes some pressure off, has a disinflationary impact, because you can buy more stuff with the strong dollar than you can with it when it starts weakening, right? So that should have some marginal disinflationary impact. Great, we need everything we can get. There are some ways in which it can sort of exacerbate tightening. It can. But also the other thing to be concerned about is sort of through the financial channel. I don't know the exact percent, but a lot of the, maybe half or something of the S&P 500, lots of corporate earnings come from abroad. And, as you start to figure out how to repatriate, hedge your currency, stuff like that, and as profit margins start to get eaten into by that, that can maybe cause some problems. Not really my bailiwick, but I can see that in having an impact on just at least even the perception of things slowing down. So those are some of the ways I can think of. Kick it to you, Eshe.
Yeah, I'd say there's a lot of ways it's affecting the rest of the world, actually. The first most obvious one is the inflationary impact. While it's disinflationary for the US, for everyone else importing goods from the US, it's making that more expensive, or importing goods that are denominated in dollars. This is also part of the energy question we have here already. In Europe, there's so much shock in the energy markets. It was already, these prices were going up already late last year, but with Russia's war in Ukraine, and I'm sure you've seen the news of these kind of mysterious pipeline explosions over the last few days. It's making it really hard to bring energy prices down, even as governments look for alternative supplies. And so that's another inflationary impact. If you're importing energy and you're paying in dollars, that's more expensive. If you're a country, a lot of emerging markets have dollar-denominated debt, that gets more expensive in these times. And then for me personally, I'm supposed to be heading to New York tomorrow, so that's going to be a very expensive trip. So I'm pretty upset about that. But for all of you in the US who want to go to Europe, the euro has just been falling and falling and falling. It is now below parity with the dollar for the first time in 2 decades. So it's an excellent time to head to continental Europe from the US and kind of take advantage of a late summer holiday.
Thanks, Eshe and Gwynn, for those responses. I wanted to shift gears a little bit back more to the U.S. and talk a bit about the stock market. We as economic journalists don't really have the stock market as part of our beats, and yet I know that whenever I talk to friends and family about my job, or they don't really want to talk about the economy per se, but they want to talk about, hey, what's going on with the stock market? So we have seen a stock market that a few months ago it would seem to be doing pretty well. Now it's fallen pretty substantially from its highs. You could call it a bear market. I don't know if people really know how many people know what exactly a bear market is supposed to mean, but people can look at their stock market holdings and see, well, they've fallen pretty substantially. Does that mean the economy is tanking too? I was wondering maybe Chris or Gwynn can go down this rabbit hole of how to equate or not equate the stock market and what's happening there with the global economy. I mean, with the U.S. economy.
Well, sure, I can start quickly. I mean, the market is not the economy, and it can go up and go down. And there's the famous phrase that the stock market has predicted 5 of the past 9, or what 9 of the past 5 recessions, because it does get it wrong. But I think you're seeing, it's a pretty standard reaction when the Fed raises rates. It makes other investments, particularly bonds, at least over time, more attractive. I mean, bonds haven't done that well either recently, at least in terms of returns. But there's obviously fear of recession, not just from the Fed's rate hikes, but obviously all the problems around the world. Other regions also facing, Europe, obviously, as Eshe has been saying, and other, China has had a bit of a slowdown. And there is on the one hand, in the United States, the stock ownership is fairly concentrated among wealthy families. There was a relatively well-known study that was updated fairly recently showing, about 84% of the value of American stocks are held by the 10% wealthiest families. So that can limit the impact a little bit, although you do have more, there are a fair number of upper middle income people with 401ks, retirement accounts. And so, I think that's another angle in which the Fed will hope to sort of slow consumer spending. And, and there is some research saying when stocks go up, consumers feel wealthier, they spend a little more. And then, so we may very well see a bit of that in the other direction now that we are in that bear market.
Thanks, Chris. Gwynn, do you have anything to add?
No, really. I think that the wealth effect thing is probably, it's by design. Like that is that's working the way it's supposed to be working. Like when people feel less wealthy, we don't know exactly. There's research that's a little bit all over the place on this, but how that translates to whether they pull back in spending or whether they spend more. That's an important channel for sort of damping consumer demand, so that translates to labor demand. But it's not. There is a, as Chris was pointing out, not the stocks are held by disproportionately by a small group of people or the value. And I think there's similar research that shows that like something about 50% of households or thereabouts don't own stocks. So how that feeds through the system, it's not totally clear. But yeah, I think that as we start to see margins take a hit, like that's a pretty good leading indicator of a downturn to come. So it is an important signal probably.
Well, also I guess then you wonder about I haven't covered it, but there are probably plenty of stories to come about retail investors and what's happening with them and the meme stocks. And are we really going to hear anything more about GameStop or AMC or any of these? Which, I mean, not to, people should invest if they want for themselves, but you see some of this, I think, on social media where, the Jerome Powell memes were all positive, or they made fun of him for, the money printer go burr. And of course now it's, Jay Powell with a vacuum cleaner. So that's, and how, how that will impact people's attitudes to, including with cryptocurrency. We've seen obviously Bitcoin and others come down in value, which is interesting, since I was under the impression that a lot of the crypto was, an alternative, and it's interesting to see them moving in sync with, so many other assets. But so there's a lot of things to dig into there, I think.
Yeah, no, we could spend hours on all these other kinds of topics for sure. I actually wanted to shift gears to a different shade of this discussion, which is talking about, not only has the news obviously been pretty kept us all pretty busy lately, but being a reporter, being a journalist has also changed somewhat in the last couple of years, and we've all had to deal with various challenges, whether it's working from home or the way news is released, or finding sources to talk to us for stories. It's been challenging, I think, across the board for all journalists, and we're just one part of that here. But I wanted to ask each of you, what have been kinds of challenges from a doing your job perspective and covering the Fed, economic matters, and so on. What are you still dealing with? How are you doing your jobs? You don't have to give away too many secrets, but just to help out our colleagues on this session, whoever wants to get started.
I don't mind starting. I'll probably take all the easy tips. So one of the things I'm just, so relieved about is being able to get back out and go to places. I think a certain type of economy story where you really just want to speak to people who are experiencing some of these big trends that we're talking about. It's one thing to speak to economists about inflation. It's another to go and find households and understand how they're dealing with it. And for the UK, all year we've been writing about this cost of living crisis with inflation so high, years and years of really lackluster wage growth. What does this mean for people? And so actually just being able to get back out and just go to a place. One of my not so secrets is that for a story that has a really vast impact, you can always just pick a point on the map and go there. If the story is truly affecting people as you in a really widespread way as you think it is, then you should be able to go to a place and people will tell you about it. And there's something to be said for going to places reporters don't always go to, because people are happy to talk about their experience, especially if they think it can help others, or if they think they can help get solutions to it. I talked to a lot of small businesses, and they're just kind of really keen to explain how it works. And that's been another really important aspect of covering Brexit, is we had the pandemic happen during that period where Brexit was kind of formalized, and then we went straight into this energy shock. And it's kind of hard in economic statistics to pull apart what was Brexit, what's pandemic, what is energy shock. But when you speak to different businesses, they can help you do that because they know what those different impacts are.
Thanks. Chris or Gwynn?
Well, yeah, being able to get out more is great. It was, in the height of the pandemic, you would talk to people, and normally you would then try to have coffee with them or a drink or whatever. And that didn't happen for a while, or it was just too difficult to get together. And so there were, a few months there where I spoke to people and I didn't ever meet them until much later. So that, in terms of experts and things like that. But yeah, I agree with Eshe. The more you can talk to businesses and people in the economy, the more they can help sort out. The data is, particularly in the US, I think, convoluted, where I think, as Gwynn mentioned, we've had a shrinking GDP, yet still hiring just in the first half of this year, more people than you often hire in a full year. So talking to companies about that has been helpful. Why are they still hiring? And there's some, clearly they were so desperate for workers after laying off so many in the height of the pandemic and then not being able to get them all back. There's, I guess, hope, or it's a little more than hope, but hope and a thought that if there is a recession, companies will try to retain workers more. They won't be so quick to lay off. I think actually a colleague of Gwynn's wrote about that in the journal today. So yeah, and otherwise things, it was interesting with government data. We used to go on site to get things like jobs figures. The Fed was online for pretty much 2 years. So that was also less interaction with some people and was not ideal, but fortunately things are sort of getting back, slowly but surely getting back to pre-pandemic ways of doing things.
Thanks. Actually, before I turn over to Gwynn, I just wanted to make one public service announcement that we are taking questions from the audience, and we'd be happy to answer any questions if you type them in the chat. We'll do our best to get to them a little bit later. Go ahead, Gwynn.
Yeah. So, and you guys have covered most of the things that I can think of, but one of the positives that has come out of the pandemic is this explosion of sort of private sector data that is useful for kind of validating or supplementing or challenging the government data. The government data is great. Got to be really grateful for how solid it is. But there's always a lag, like JOLT. That's critically important. The job opening and labor turnover survey is so important right now because it's that indicator of labor demand and quits and just how tight the labor market is. It's 2 months behind, so your GDP is like a month or so behind. It's really hard to get a real-time read on what's going on at this time when things are changing incredibly fast. Like trying to get ahead of what's going on at these turning points, like post-vaccine, obviously in the first year, but post-vaccine, and then like right now, it's when the energy stuff really started hitting hard in the spring. In having these alternative sources has been really amazing, and it's a really good thing to come out of the pandemic, and it's to the point the Fed is has been they've been working on it for a while, but these real-time surveys, you can get some of them, like new sources of data on Fred, the St. Louis Fed's pretty awesome data platform. So it's democratized. It's not just like the Wall Street Journal got an exclusive with Indeed or something, and so everyone can kind of keep tabs on these things in a way that has not been possible before.
Thanks, Gwynn. I can definitely second all those tips from all of our panelists that they just were talking about. We do have one question that just came in from one of our audience members. Thank you very much. The question is, as a local business news reporter, what are some key nationwide economic things I should be looking out for when it comes to having an impact locally? Maybe Gwynn or Chris want to take that.
Well, sure, I can jump in. Housing is a big one. Housing is already, messed up in a lot of American cities and towns and areas, and in terms of demand and supply being out of whack. In many cases, there are issues around, zoning and building, development policies. And so now on top of all that, you've got this big rate hike, and again, mortgage rates more than doubling just in 6 months or so. So there'll be a lot of issues there. I also think looking at businesses, I think the issue with these big rate hikes that one thing we haven't talked about is just where are the the hidden, we don't know because they're hidden, but the things that are going to be companies that have borrowed too much money perhaps, or that's usually if something that plays out when you have these big rate hikes. The Fed was hiking rates before the 2007, 2008 financial crisis. That was not the only, I mean, that was a factor certainly in that, many people, as we all know, who couldn't really afford a lot of the homes they bought, and the assumption was they could refinance their mortgages if they needed to. And all of a sudden when rates went up, that wasn't really possible. And there's also been times in the past when, higher rates have caused problems for companies that borrowed a lot of money. I mean, right now, many households are in better shape financially than they have been in the past. You've had, there is less debt. You had all the government assistance that, at least on average, did increase most Americans, or many Americans, financial cushions. So in one sense, I mean, that's a source of, I guess, comfort or reassurance that, we are likely to have something certainly not as bad as in 2007, 2008, but presumably, particularly on the local level, there may be, businesses out there. I know that a lot of oil drillers, the smaller oil drillers, recently were considered to have a lot of debt. So how all those businesses are going to handle that increased debt service, and then any state states generally have to balance their budgets, but any government agency that, has been borrowing at a low rate, if they are now going to, if they've been borrowing short term, they have to roll that debt over and now going to have to do it at a higher interest rate. That could be a problem for them. So that is something to look for. But, and again, on the consumer level, mortgages, higher credit card rates, those kind of things, are definitely something to look for.
Yeah, to that I'd add, so there are the sort of like recession chasing questions of like what's happening with employment. And, as Chris brought up, like labor hoarding, like has the trauma and expense of trying to hire in this, labor strapped market, is that causing employers to hold on to workers that in a way that maybe they wouldn't have otherwise, or even hire. So, and then tightening, like we can look at, the many measures of how restrictive, financial conditions are, but how are those being experienced by different parts of the economy? Like that's important for understanding how, Fed policy is percolating through. And, so that's something that I would be interested in knowing about. We saw this huge explosion in people starting new businesses during the pandemic. And I haven't kept on top of that data recently, but I imagine it slowed down because how could it keep going? But, sort of what's happening with that big thrust. I think that could be really interesting. And then there's also like some pockets where you have these really severe labor shortages, like local governments, that employment really hasn't come back, and like what is happening as a result. And then also I'd want to kind of know about like pandemic lessons, like are we seeing, how companies source, how they organize their supply chains, where they are locating their production, who is doing the work. Has that changed as a result of like incredibly traumatizing experience? You hear a lot of stuff about onshoring. And you have obviously these, new pieces of legislation that's incentivizing it in certain areas, but like, is that really happening? Like people have been warning about the end of globalization for a while. Like, is this really the tipping point? I'm not sure. So yeah, which of those adaptations are going to be sticky?
Thank you. We just got another question from another audience member. The question is, I'm based in Northwest Arkansas, home to the headquarters of Walmart, J.B. Hunt, and Tyson. What is one tip you can give to an emerging journalist covering large companies and their impact on the local economy?
Well, yeah, that's an interesting area you're in. I did get a chance to go to the Walmart annual meeting a few years ago in Bentonville, and that was fascinating. I mean, you can see some impact of Bentonville is a nice, quite a nice town. But that's a good question. There's all kinds of things. I think one thing might be anything from, what kind of benefits are they, or how are they changing their hiring practices to attract workers? But I think, on a higher level, I mean, it's a little harder with Walmart maybe, but certainly some of the issues Gwen mentioned, are they, and for anyone else who has these kind of employers, how much are they trying to bring back business or manufacturing? How are they reacting to the supply chain problems is certainly an issue, I think. And then one sort of constant question is, where are they getting workers? I mean, if they are going to bring back production or whatever, where are they going to find those workers? And in some cases, I'm not sure if this would be an issue for the companies you mentioned, but for one, when Amazon looked for their HQ2, there was always an issue of, a lot of those jobs were higher end, highly educated, or at least, fairly educated jobs. And, were they going to hire locally, even though that was the big promise that they were going to bring these great jobs. But I think there is some research showing that in a lot of cases, the companies have to go outside the area to find people, and then they bring them in. And I mean, that might be good for that region, but if an area doesn't have the level of educated workforce, or just they're not that many, then there's a limited benefit. So those are some angles, and then what they do to the housing market. I mean, again, I don't, Walmart and those have been around for some time, so it may not be precisely an issue there, but I'm in Arlington, where one of the two HQ2s is being set up, and so while we're okay so far, we don't quite have. Although there are actually some local housing issues and some fights about what kind of housing to build. Anyway, are those companies making any kind of provision for for whatever housing they need? I mean, I think the famous examples are more in places like San Francisco, where it's 10 when you have X number of jobs added in the past 2 years, and yet X minus 50% in terms of housing units. And so how does that play out? Anyway, but no, it's an interesting question.
Yeah, I would just tack on to that. With Tyson, I've never been a corporate reporter, so I'm sorry, I don't have anything. I can just tell you what I want you to figure out. I would want to know about immigration and sort of the issues there. How is that affecting the workforce, and like how you, like automation, maybe investment for Tyson at least.
Thank you. Yeah, just a reminder, if you have any questions, please enter in the chat. Someone else also added that the Bureau of Labor Statistics, BLS.gov, has a lot of local stats, and that's always a great resource for people looking at impact on local economies. They have state and kind of metro area statistics. I did want to ask another question to the panelists, actually, and I'm kind of interested first in what Eshe has to say. We do have, like you were describing the situation unfolding in the UK right now, and kind of looking out over the next 3 to 6 months. How do you expect that to play out? How do you expect to cover that? There's obviously a lot of ways that it can develop, but I'm wondering, what would be sort of, is there a way that you can plan out to cover this sort of thing, because it's happening so fast? I'm curious your thoughts on that question.
Yeah, that's a good point. I feel like I looked a little while ago at a list of kind of like stories and themes I wrote in January for this year, and it's kind of hilarious because there's been no time for any of it, given coverage of the war and the energy shock, and now recessions, higher interest rates, inflation, etc. But it's definitely difficult to know how this will play out, and I refuse on the record to be drawn into making any predictions, because if there's one thing you can say about the UK government is that it might confound your predictions at all times. So the key is to really leave yourself some room for news. I would say, even as we're planning, like I did say that the government has told us late November we'll hear from the Office of Budget Responsibility. They will lay out a fiscal plan. That seems really far away. So I think expectations around that coming forward, being ready for like what are the options of things they can do? What are we likely to hear? And kind of having your sources ready for what those options could be is the main thing. The other thing to keep following is the markets, the impact. We talked earlier about like the stock market and how, it's not always it's not a great indicator necessarily of the economy, but when markets move as aggressively as we have seen over the past few days in the UK, that does have an impact. One of those impacts was that some lenders started pulling new mortgage offers to people because the yields were moving too fast in the bond market. They just couldn't price them. So, how that is affecting people, and thinking about, okay, the pound has really dropped. It was kind of drifting lower already. We've talked about the impact of the dollar, but when it's that much lower, how does that start to affect people? Does that catch companies and their hedging policies out and all sorts of things? So just kind of being aware of there are things that are likely to change, or there's more reaction we can expect to hear from the government, but then there'll also be the impact of the stuff that has happened that is not necessarily about to reverse. So just keeping a lot of room for it, and also remembering that like there's still other things going on while we're writing about this story. The other themes that we have in the UK is that the cost of living has gone up a lot, even though there's a cap on energy bills from, oh gosh, in like 2 days, energy bills still go up a little bit. And so that average household bill will now be £2,500 for a year, which, it's a cap, but that's a lot of money. So there's still stories to be written about these kind of other economic trends that are happening below the surface of all this volatility.
Thank you, Eshe. We're starting to run toward the end of our allotted time. I did want to answer one more question that was in the chat, and this is something that it could probably take hours and hours to explain, and I don't even fully understand it. But the question is, could someone please give us an update on how the Fed changes short-term interest rates, such as the Fed funds rate? What are the mechanics these days of how the Fed executes policy changes? It's actually changed a lot in recent years. Chris, do you want to try to handle that one as briefly as possible?
Well, yeah, sure. No, shouldn't. I think, well, there are so many reserves, as we now know. You've heard, or many people have heard of the Fed, like other central banks, buying bonds. They now have a balance sheet that's nearly $9 trillion, and much of that money is sitting in banks as reserves. So what they have done is there are different, actually short-term interest rates that they set. One of which in particular, interest on reserves, they now pay. This is a new thing, as Scott was implying, at least new since the financial crisis in 2008. So they pay an interest rate that's very close to the Fed funds rate, the one that they set, and they pay that to the banks essentially to keep them from lending out at higher rates. And so it sets a certain floor that you would never lend anywhere else at a lower rate if you could get this certain rate from the Fed. So that's a And then there are some other related rates they use to sort of keep it in the range. But the old way was they would buy and sell treasuries to affect the overnight funds rate for banks. That has sort of gone by the wayside. So now it's really this payment of a short-term interest rate on reserves that keeps a certain floor under rates. Yeah, and that's as brief as you can get, and it is pretty complicated. It's very, in fact, back in the Paul Volcker days, it was, he made the decision to let the money supply fluctuate, and that was a whole different story, and they had a different rate. So, we could go on and on and on about that. Anyway, we're pretty close to 2 o'clock Eastern here. I did want to offer the panel a minute or so to offer any closing thoughts or anything that they wanted to mention that we haven't talked about yet. So anybody wants to go ahead, go for it.
That's tricky. I'll think of something. The other thing I just like to think about as an econ report, especially being based in Europe a lot, is climate change and like the net zero transition for companies and households here. It is a really important story. It's become even more important and more complicated by trying to kind of find alternative energy supplies for lots of continental Europe from Russia, but it's still this important question, especially if you are then to talk to businesses, talking about kind of the future of growth. It's like, where will these investments come from, and how will they grow? And it's just the kind of another way of thinking about econ stories.
Well, one thing we didn't totally get at was the whole recession definition issue, which is also a thing that you could talk about for a long time. And in fact, my recommendation would be to avoid getting into arguments about, is a recession 2 quarters of shrinking growth, by which definition we would be in a recession. But as most of people know, the recession is defined by a committee of economists here in the US. And my sense is, or my talking to economists, I think the real definition, although I think in Europe or in the UK, it is the 2-quarter rule. But here, in the US, what you usually see is that until you see real job losses and a rising unemployment rate, it's unlikely that the committee that decides whether we're in a recession, I think that the job market will be one of the key things they look at.
Yeah, let's see. Those are both useful things to think about. I think tagging on to both those, like, it's useful to remember that the unemployment rate, when it starts to go up, it's usually like non-linear, in the sense that it doesn't go up like a bit. There are feedback loops where, when people are laid off or job security is threatened, people pull back on spending, and then people who work for the companies that would have gotten that spending lay people off. So, that's a dynamic that I didn't mention that seems important. And in reckoning with this soft landing, hard landing thing, that is just usually the way things go, is towards the uglier side of things. And then on Eshe's point, that's cool that you brought that up. Yeah, I think that, like, it's possible that we have gone through the last decade, or maybe a little more, in this, era of at least in the US, of relatively abundant energy. And maybe that had some monetary, like, was sort of made things a little easier on monetary policymakers, along with, globalization and things like that. There's other structural factors. And it seems increasingly clear that we're coming into a period of just structurally tighter energy, and, like, in a way that, I don't remember. A lot of people, working in our field don't remember, probably, and a lot of the people we're interviewing don't. So this is, these weird new times, and I think things, models that we have gotten used to maybe don't apply quite as in quite as straightforward a way as they used to.
All right, well, with that, we can wrap up. Thank you very much, Gwynn. Thanks, Chris and Eshe, very much for joining the panel today. And thank you to our audience members, for everybody who joined us. I hope you found some of this useful and not too overly complicated. And one other housekeeping announcement, I did want to mention that everybody can check out SABEW.org for the next monthly session. There's an interesting skills workshop coming up on October 14th. Thank you, everybody. Have a great rest of your day.
Thank you.